Well, thanks for making it into the panel this late in the day. And I think everyone's excited to hear about what value we're bringing to the tokenized assets that are already on chain. And then hopefully after everyone gets to partake in the happy hour outside, huh? All right, so I'm Lydia, SVP of Corporate Development at Ava Labs. I lead Corp Dev as well as Blizzard, the Avalanche ecosystem fund investing in Avalanche-based projects. So I would love if all of our amazing panelists can introduce themselves, and we'll kick it off with you, Rhett.
Hi, I'm Rhett Shipp, founder of Avant. So in brief, Avant is a yield-bearing stable value token, and so mintable from USDC, and then that USDC is put into a diversified portfolio of yield-generating strategies in DeFi. So we think of ourselves two ways. One is democratizing the access to DeFi yield, and then the other is driving liquidity to high-quality protocols like some of the people on stage and other DeFi protocols.
Yeah, hi, I'm Bernardo, head of BD at Beckett Finance, and we also do tokenized Securitize. Right now I have 17 products ranging from T-bills, Eurobonds, Swiss bonds, and other fixed income, but also we've been focusing a lot on equities. I have tokenized NVIDIA, Tesla, Google, Microsoft, MicroStrategy, and so on. Yeah, happy to be here.
Hey, I'm Karn. I'm the CEO of Reid. We're an on-chain reinsurer. Think about us as an insurance company for other insurance companies. The crypto analogy is real-world restaking. We take stables, tokenized treasuries, tokenized money market funds, any other high-quality tokenized assets, and we enable the holders of those assets to pledge them to a collateral pool that could back every insurance company in the world and earn a risk premium for doing so. We're going to extend the idea to be able to provide economic security as a service to any real-world business that requires something like a letter of credit. So think about trade finance or all of international trade. That would be within the scope of what we do. We back 18 insurance companies, just under 100 million in business.
Hey, I'm Reid Simon from Securitize. Securitize is one of kind of the old OG tokenization platforms. We're an issuer of mostly private securities that ranges from private equity, private credit, equity, and then we're probably most familiar for issuing BlackRock's BUIDL token, their money market fund.
Well, thanks everyone. So from the mix of the different companies and firms that you're all with, we're definitely talking about real world assets or traditional financial assets being tokenized. And with it comes a lot of regulatory and compliance overhead. And the main question is, what value do they bring into the existing DeFi protocols that exist on chain? So I would love for any of you, open to all of you, to help us understand what RWAs are getting the most traction currently on chain, and where do you see the most traction of the integration with DeFi?
I can kick off, maybe. Sure. I think it's clear that the first RWA is stablecoins. Of course, nobody disagrees with that. And the evolution, in my opinion, is yield-bearing assets in the fixed income space. It's been T-bills, and of course Securitize has been doing a great job with BUIDL. And I think the evolution goes in this direction from very safe assets that have a low risk coming from TradFi to generate new yield sources or revenues from TradFi to DeFi protocols. And then we start to add more risk, right, like credit and private equity funds and equities and different kind of verticals in that.
Yeah, so I think I would I agree with you. I would probably make a distinction though that there's all types of real world assets, right? And some of them are securities and regulated and permissioned. And then there's other assets that are real world assets but don't have kind of that regulatory burden or positives, depending on how you look at it. But I agree. I think credit products, probably mostly because of the way that, in traditional markets, you issue debt for a reason. And that doesn't really exist in crypto because you have utility tokens, so you can kind of fund yourself through that. And then what's really the point of issuing debt? So you get interest rates on chain that are really a function of like supply and demand and whatever incentives are getting thrown. So I think we're seeing a lot of demand for T-bills, partly because we're in a higher interest rate environment, but also there's not really stable yields on chain that are divorced from kind of the realities of supply and demand at any given moment.
Yeah, I think we can dive into that a little bit, right? Like there's this separation in bringing actual asset-backed yield on chain versus the historically more speculative yield in DeFi. So how do you marry that? How do you bridge that gap with the asset that you guys are all working to bring on chain and kind of solving for a different audience, right? Like different set of users that are interested in DeFi?
Yeah, the answer I think is not very well. Like we're talking about security tokens. We're talking about things that don't necessarily play very well in a permissionless context and don't necessarily have the same sort of strategies, let's put it, available to drive some of the yields that you otherwise see in DeFi that are couched in effectively playing zero-sum games, right? Without the use of an underlying productive asset. I think there probably is a future where some of these RWAs and things that have like economic substance to them can be put to use in a similar way that permissionless assets can. An example of this is taking a USDC, placing it into ostensibly a vault, deploying into a strategy that delivers a return, or taking USDC and treasuries and effectively restaking those assets to insurance companies around the world to deliver a risk premium in a very similar vein to what you would see traditional restakers do in the DeFi permissionless context. But I think the short answer of it is it's not yet attractive, right? Like T-bill yields are not attractive, even at elevated. We're on a downward trajectory for interest rates, but like in the context of what you can earn even in thin markets elsewhere, it doesn't really make sense to DeFi folks. But yeah, right now, if I were just to zero in on what works, it's just stables, right? And stables will continue, and it's very clear because there's a gut punch product market fit there. It's unclear to me that it exists anywhere else yet.
Yeah, I think everyone here has stated the obvious that stablecoins is like one of the, if not the biggest product market fit of crypto. And Tether's got what, 120 billion or something, and they give no yield at all. So yeah, totally agree with that. And I think to me, as a super DeFi user, it's nice to have these treasury yielding stables now, because it just adds a yield floor, right? So for the heavy DeFi user, in the 2020, 2021 bull markets, stablecoin yields were like insane. You could get 100% yield, not that difficult to find. When the bear market comes in, Aave, borrow demand dries up, your yield floor is like really close to zero. If you can set that floor now at 4%, that's a notable benefit, especially in bear markets. So from the DeFi perspective, that's like, I think, a pretty big deal, even though it's like, that's not degen yield, but it's really, I think it buoys up the entire DeFi ecosystem.
Yeah, if you would have told me before I joined Securitize that we would be working on T-bills at 5%, that's not sexy, right? Issued by some of the largest asset managers, again, not sexy for a DeFi user. But I think it does become really interesting when you start to think about these assets as base assets. So they're quality off-chain managers that crypto gets to build on top of. And I think that's really kind of when the use case starts to unlock. And if you look at even just in traditional markets, like cash versus treasuries and the amount there, right? In traditional markets in the US at least, it's 3 times as many treasuries, 10 times as many treasuries as there is cash. And on chain, it's the inverse. So I would expect that those things are going to grow, And as we kind of figure out more use cases and unlocks for how they can interact with DeFi, I think we will start to see more sexy things kind of built on top of them.
Yeah, and maybe just to add some specific here, like, of course, it's very interesting and sexy to have 100% yield, right, on a DeFi protocol, but that's just not feasible, right? Like, that's maybe very early pilot testing, a lot of smart contract risk. A TradFi institution would never come to a market in that maturity level, right? And I think it's actually very healthy for the whole ecosystem that we are testing this whole open source finance environment that will slowly begin to be more adapted, more adopted from big TradFi institutions, right? It's a big infrastructure change for the capital markets, not like a new sector in crypto.
Yeah, I think, you know, everyone touched on how stablecoins are certainly the first, it's kind of like the first RWA that found product market fit. But there have been many different types of assets that, you know, there have been panels all day here on this stage and other stage. We're talking about cultural assets, talking about loyalty points and game points and everything. So far beyond kind of just financial assets. And, you know, a lot of the overall consistent themes is tokenization brings transparency and distribution. And so within the world of RWAs or TradFi assets, like how does bringing that on chain offer benefits in those areas? And fundamentally, you know, the biggest problem has been distribution. So I would just love to see how you guys, you know, are operators and every day, like how do you see distribution being addressed?
Yeah, so I mean, for my purposes, my customer is an insurance company, right? And the insurance company has a singular motivation, that is to write more insurance business in a profitable way, and however it can access the collateral and capital that it needs to be able to do so. So it demands capital, and I effectively sell money, right, at the end of the day. And so if you've got these crypto economic assets that have value that you can now find a way to turn into compliant collateral, you've unlocked an entirely different capital market for $1 trillion business, right? In a world where we are desperately in need of increased global insurance capacity, right? And so for us, it becomes more of a pitch around, to your point, transparency. What I need to do is prove that I have the collateral in the case that the insurance companies need it, and we can do that in a cryptographically verifiable way. There is practically no better way to do it as it stands, but then meet the insurance companies in the way that they would otherwise do business, use the existing rails for distribution, reinsurance brokers like Aon, Guy Carp, Gallagher, and ingest data from these insurance companies, the rails that they typically provide those things, and do kind of all of the work ourselves to transform the insurance industry into something that's now palatable and observable on chain. So the short answer is do all the work. Do all the work and use the existing distribution rails.
I think distribution access in general is one of the fundamental value props of the blockchain, because these are permissionless open systems. And so then just extending those to new things, and sorry to keep going back to stablecoins, but so much of the world is desperate for dollar access that there's just no other way to get that except for through a blockchain. So, you know, you go to Turkey right now, you can buy a coffee with USDT at like any coffee shop. And there's just that massive demand, and there's no other way for most of those people to get access to these assets. So I view that as like, just like, that's like the base fundamental value prop of a blockchain is permissionless, open, you know, yeah.
So I think for Securitize, you know, we sit kind of in, our customers are on both sides, right? We have issuers, asset managers who we need to distribute the product to, and then we have chains that we have to issue the product on, right? And so I think one of the friction points for us on the distribution side is, while there's all these great benefits to blockchains, which is why we're all, you know, here and working in this industry, is how do we make them interoperable with the way that people are using crypto today? So we've been working with AVAX on a feature that enables kind of toggling of whether a security is being used as a security or if it can be used as collateral in DeFi. So I think sitting in between both users, we've kind of had to also build out technical solutions that kind of allow these things to interact in the immediate term, legally, responsibly, and compliantly. But that wouldn't have been kind of the, I guess what I'm saying, I didn't really totally realize that would be something we need to be building at the outset because of how, I guess, ingrained the way that DeFi operates. It's a difficult challenge, but one that we're sorting to build solutions for.
Yeah, and for Bakkt, we are, first of all, we are a B2B company, so having the right distribution channels is very important for us. And the way we see ourselves is like building these tokenized securities that are very solid, very robust primitives, so other companies can build on top of that and offer to countries and people and investors in emerging markets like Argentina, Brazil, and Nigeria, Turkey, South Korea, Philippines, etc., assets that are hard to access, and we leverage that with our regulatory framework. Maybe we can detail that later, but in a way we do very well delivering tokens that are freely transferable on EVM chains right now. So our tokens, even if they are securities, they are ERC20. So any of our B2B clients, partners, can buy these tokens and then they can resell, they can offer to the end users that actually is accessing something that is hard for them to access in other rails.
Yeah, that's actually really interesting I want to dive a little deeper into, right? Because you're talking about tokenized securities and then having those tokens be composable for other companies, other investors to build on. So how are you addressing that? Obviously we're talking about international jurisdictions, regions. How do you kind of manage that for the users of Bakkt?
Yeah, so we're regulated in Europe. We have the mother company in Switzerland, and we have a Jersey Island subsidiary where we hold 2 licenses to offer tokenized securities. And all of our tokens are retail graded. We have a prospectus in Liechtenstein, so these tokens can actually be sold legally. There's no gray area, no weird doubt for retail users in Europe, but we don't do that ourselves, right? Like we see this, we see ourselves as this primitive builder, this infrastructure player that can deliver very solid, very robust one-to-one backed tokens by TradFi instruments. But then we need these partners that they also need to have their own licenses and their own legal framework to actually sell and offer these securities publicly to retail.
So to extend that a little bit, right, when it becomes usable in this permissionless environment, do you guys see any use cases or have vision or have like kind of this roadmap for new financial products that are currently not available via TradFi rails, specifically because we're all operating in a permissionless blockchain network? I'm like super interested in this.
Yeah, so in TradFi, right, let's say you had a brokerage account with an equities position, a fixed income position, some cash. What you could do is you could borrow against that account, have a letter of credit issued over top of it.
What's the discount though?
I'm sorry, what's the discount?
Yeah,
it really depends on what the underlying is. So for example, if it's cash, it's 1-to-1. If it's a short-term treasury, it might be like 90% to 95% as credit. If it's equities, probably more like 70%. And then depending on what grade the fixed income instrument is, it could be variable, right? But the point of that is that it effectively emulates the composite. We're talking about tokenization of assets. Tokenization for the sake of tokenization is not a very good business, right? What you need to now move into is a stylized example. Let's talk about the entire tokenized treasuries market. It's like $1 billion, right? So what's the spread on that? 10 bips. We're talking about $1 million in revenue, right? If I'm counting my zeros correctly, it's $1 million in revenue for the entire tokenized treasuries business as it stands. That's stupid. It's not a real business, right? And so where does it go from there? The question then is like, hey, should I be able to trivially pledge these treasuries, these underlying yield-bearing assets to unique purposes, as you kind of pointed out? You were relying on human ingenuity to come up with these unique cases where, hey, you've got security instruments over top of these baskets of whatever instruments that could be used in the broader DeFi context to serve a certain purpose. And generally speaking, within a DeFi context, it's economic security for some other action, right? For which you are paid for providing that security. But as a tokenization for the sake of tokenization, there's no money in it.
Well, go ahead.
So, yeah, so my view, from the DeFi perspective, if you take a look at DeFi Llama, the top 10 most heavily used platforms, almost all of them are yield related. Liquid staking tokens, restaking, which is related, and then lending protocols that have mostly facilitated lending protocols and like yield trading protocols. And it facilitated people to make use of those liquid staking tokens, trade yield, trade volatility, et cetera. There's this rise of this term last year, like LSTFi. So much of DeFi was around liquid staking tokens. I think RWAFi, which is like kind of maybe a thing that's emerging more now, is a lot of the same stuff, but now instead of yield on ETH and AVAX and some of these other volatile tokens, it's on RWAs. And I think there's like just this enormous demand for people to trade yield and trade volatility. That's maybe not as much of a thing for like a tokenized treasury, but trading yield is like already, I think, one of the biggest things that people are doing in DeFi. And plugging a lot of the RWAs into this is like just a very natural fit. And then one other quick thing that's just like kind of an obvious is, I know a lot of people that stay out of things like Polymarket because, hey, I'm going to put on this bet for months, and like that USDC, there's like a lot of opportunity cost. I could have been utilizing it, capturing yield, et cetera. If I can put on my Polymarket bet with something that's yield bearing, then the opportunity cost isn't quite so substantial. So I think those are obvious places these can just be plugged into, and there's a lot of people who are sitting on the sidelines that would come over.
So I think the Polymarket example is a great one, and one that I've used to kind of explain some of the stuff that we're doing and that opportunity cost and how can we unlock that. So I think the interesting thing that we've been working on with AVAX is, if you look at what defines a security in the context of a treasury, it's some stable value component and then the return. And it's just that return piece that is ultimately what makes that asset a security. So being able to bifurcate the stable value component and the variable return, and being able to kind of extract and use that stable value component of any asset. With a money market fund that's stable NAV at 1, that's pretty easy. But then if you start to look at even other private assets, right? These funds, they don't drop by like 30% in a day. Most of them only get marked once a month because that's kind of the level of volatility that the underlying investments actually have. So when you start to look at that and you say like, okay, if I have a private credit fund that's returning, call it 10%, it's managed by a firm that's been around for 100 years. The fund manages, roughly $1 trillion. That asset probably has a stable value component to it that is usable. Let's say it's 50 cents, right? That starts to become a bit more interesting then when you've got a yield of 10% from an asset that's really high quality, and I can use maybe 50 cents of it in Polymarket, right? While still retaining that yield. So that's what we've been building on kind of the technical side that allows this toggle ability of, I'm not using a security in this context, but I still own the security.
Yeah, I'll maybe add an anecdotal example on Reid's comment here. Today I got a client asking like, hey, could I have 3x leverage on MicroStrategy token and something like that? I'm like, potentially yes. The infrastructure is not there yet, but you can potentially like use a leverage protocol like Euler, for instance, to do that. And I think this is the stage that we are in the market. There are people smart people building new integrations and new ways of, the building blocks of DeFi, with the caveat that you need to have a regulatory approach. It's not just doing the smart contract, right? I think that's the challenge in this space.
Yeah, regulatory is kind of like one area that it's kind of hard to not talk about, especially when we're talking about securities and RWAs and everything. So is that a blocker to increasing the value of RWAs on chain? I mean, ultimately, what happens right now is, as an investor, you buy them and you hold them and you collect a yield. And I think, the topic of this conversation is how do we go beyond that, and who will build the infra for us to get there? So are you guys building it? Tell us more. I would love to hear what you guys are doing on that front to get us to that vision.
I can give a quick comment.
Yeah.
We're not directly. We're very B2B, building the primitives, but we do have, partners and other startups that are building on top of us, and chains like Avalanche and other chains that are facilitating this new ecosystem, right? And I think the challenge is many crypto founders and people that are born in the crypto community, they don't understand the compliance and the regulatory challenges enough to understand how to overcome these issues, right? So I think there's a lot of educational and knowledge that we need to work together as an ecosystem, as a community, to overcome and learn more with the TradFi people, right? Like with capital market players to actually deliver that.
So, we're not building it. We're not doing the last mile, at least I should say. Our focus is much more on being close to the base asset and the highest quality of those assets, tokenizing them, and then working through partners to be able to unlock the ultimate utility, right? So in the case that we've been talking about, like Elixir is a protocol that we've been working with in this context with AVAX, where their mindset, when you look around like point in time liquidity versus like quality and volatility and duration. And I think that's an opportunity that we're able to capitalize on, where like we can bring solutions to market that other people will enact, and they have a separate business case and business model around making that work. So we're much more focused on kind of as I said, being close to the asset and then working with partners to figure out ways that we can help further distribute.
There's a slight vibe shift happening, right? Like I think folks are kind of waking up to, hey, like this negative sum casino can't ride out forever for all of these high rollers, and there is demand, right, for for things that are linked to real world economic activity that makes sense, that somebody can draw on the back of an envelope and kind of understand what's driving value, right? And so there is an element of that vibe shift, and people do recognize that things need to move in this direction for DeFi and for many crypto asset ecosystems to be sustainable in the long run, right? These markets that we're talking about are orders of magnitude larger than the crypto ecosystem as it stands today. And if you can build connectivity into them that is compliant, even in a shifting sands regulatory environment, you act in good faith, you do your best. Unfortunately, we end up spending millions of dollars to show that we're acting in good faith.
Plus your current tokenized money market fund generates $1 million in revenue already, right?
Like, it's like that just goes right to the lawyers. The lawyers win. And so, there is a path forward here, and I think it's just going to come with maturity of the market and showing that, like, hey, these opportunities are available, and there's now a direct link to make them accessible in a distributed, decentralized way, right? It's going to happen.
Yeah, so our platform is very DeFi-centric. We're deploying DeFi-only strategies. So we're here waiting as compliance is figured out by others, and then we can access those in DeFi, then we deploy. So we are ready and super eager for all of these, but we're kind of on the other side of it. We are, the demand for this, and just waiting for those to come to be available to us, basically.
Well, if I'm hearing everything correctly, it sounds like We certainly have everyone on stage who's building out the pieces to get these assets on chain. And then we have platforms that are kind of like on top of that, on the DeFi side, ready to take advantage of the yield and the value being brought by these assets. But there's no one in the middle, or very few, that are successfully able to cross that chasm due to regulatory or compliance reasons, whatever it is. It's a hard problem to solve. Sounds like we need quite a few lawyers up here to talk about it.
Gary Gensler's in the middle.
But with an eye towards the future, and let's say like we get there, right? Like there's enough clarity. Maybe not in the U.S. Sounds like Europe is a very friendly place. I mean, and we all know that there's a little bit more clarity. We may disagree on what that should look like, but in terms of like the infrastructure and what's happening and upcoming technological advances, what could accelerate this? If you could pick, this is like a request for startup, you just need someone to build that middle piece for you, what would you want them to build?
I can start, and I will not chew back here. I will show my country, Brazil. I think Brazil is doing a great job on our CBDC platform. It's called Rex. Maybe many of you knows already. But it's actually, blockchain-based DVP settlement on chain on the whole country level, guaranteeing property rights directly to token holders, like in a very friendly, compliant, legal way, like very pro-tech, from the central bank, from the regulators, from everyone in the space. And I think builders could learn from what is happening there. And replicate in different countries, right? Like when we're speaking about compliance and regulation, you need to deal with government, and that's challenging and cumbersome. But in the end, like that's the only way, right? It's I'm happy that we have somebody that's better than Gary in Brazil right now. And I think like just to give a very quick example, there's one startup in Brazil that is doing tokenized real estate. Not in the way that most of the crypto players are doing in the rest of the world. They are tokenizing the deeds, the properties in the base level, and then every other transaction after that is happening on a blockchain, 100% safe, compliant, legal, and this is already like growing a lot. So this is, I think this is the kind of, it's completely away from the meme narrative. Like there's no promise of investment or potential 10, 20, 50x. It's just a very good, more efficient way of delivering real estate settlement and transaction. Like instead of paying 6-7% to a notary, you're gonna pay 1% to a tech startup that is gonna do the transaction DVP on chain. I think this is the kind of things that should like move us, have us moving forward.
So I'm quite a bit more focused on the user side still, and I think that there's a lot like this piece in the middle you're talking about to be fleshed out for sure, but there's already a ton of, people have access to non-yield bearing stables, tons of them, and crypto assets, and then there are already available permissionless yield bearing stables as well, et cetera. So I'm really bullish on just making the user experience to make use of those better. So like, one thing, for example, that I'm pretty bullish on is this new like MetaMask debit card. You can fund it with ETH or AVAX, you can fund it with stablecoins, you can fund it with yield-bearing stablecoins, and then just go spend. In many countries it's already live, you can just go spend, and it feels like you're just buying groceries with whatever. And as more of these RWA assets come on chain, you can just plug them into that. But I think we're ready to be deploying those things now.
So unfortunately, I don't think it's any tech solution that is really going to do it, at least in our case, right? We keep up with all of the trends, they're all accretive, but ultimately, I think the situation, at least in the US that we're in, is that there are pretty clear rules on what is and isn't a security. In our case, basically everything we issue is. But the challenge is, how is it going to be enforced, right now at least? And I think that has scared off a lot of very honest actors from doing things the right way. And being willing to explore how can we solve this, but because of this enforcement or rather regulate by enforcement, honest actors are really kind of disincented from being honest and exploring that area. So I think once we get some more clarity on like, oh, these are the rules and this is how we're going to enforce them, I think that will be a big unlock for honest actors who come in and say like, yes, this is a legal and compliant way to interact with these securities. But right now, a lot of them are afraid.
Well, sounds like we'll have more clarity in a couple of weeks in the US, at least for you, yeah.
Hopefully.
Hopefully. Well, thank you everyone for your time, and thanks for joining me on the stage for this great conversation. And thanks everyone for coming on this second day and this late in the afternoon. Have a good one.
Thank you.
Thank you.